When it comes to fixed income, as long as inflation is still a concern, your yield curve will remain somewhat elevated. And as long as the yield curve remains elevated, the yield that you get on your fixed income investments are now much higher. The fact that all-in yields are now higher actually bodes well for fixed income returns going forward.
This problem that we are seeing among investors today, and is that a lot of them, they tend to just hold one global fixed income fund. But the question that they have to ask themselves is, are they having a truly diversified exposure? Investors just have to be willing and also be able to uncover some of these good solutions.
Welcome back to Chills with TFC. I'm your host, Reggie, aka your Chief Financial Coconut. And today we are in studio once again with our friends from Aberdeen Investments to talk about the crazy world out there, like what's happening in the macro trends, what's going on, and how does that translate to your fixed income, your credit strategies, and provide a framework to look at the world and look at these tools. So once again, I have to be joined by one of my favorite co-hosts, right? Dave.
Yeah, hi. My name is Dave. I'm a minimalist financial coach, and I have this blog called Minimalist in the City. We talk everything about personal finance and then talk about minimalism.
And we are excited to be back with Natalie. Right, for our audience that somehow did not see the first episode, could you introduce yourself?
Hello everyone, I'm Natalie Tan, Head of Wholesale for Southeast Asia at Aberdeen Investments. So my team and I were responsible for sharing and promoting Aberdeen investment capabilities to our distribution partners and helping them to identify the right investment solutions for their client base.
Okay, so what's so capable about your strategies in the fixed income space? Because the other time we talked about equities, right? So maybe you can share a little bit more.
Yeah. For those of you who are not familiar with Aberdeen Investments, we are a global specialist asset manager. Today, we manage about $550 billion on behalf of our clients. We are headquartered in Scotland, and our firm history actually dates back to 1825. And we are no stranger to Asia. We've been around for over 30 years. And at Aberdeen Investments, we have a wide range of investment capabilities spanning from equities, fixed income to multi-asset, alternative investments, and real asset. And of course, today the spotlight is on our fixed income capability, our credit solutions.
Yeah, so we drag the specialist here. So for our audience that don't quite know you yet, maybe Nathan can introduce yourself.
Yeah, I'm Nathan, the fixed income investment specialist at Aberdeen here based in Singapore. So the investment specialist role really sits between the distribution groups like Natalie and the investment teams or the portfolio managers. And we help frame and context our fixed income views and solutions for end clients.
Okay, fair. So let's roll right into it, right? Which is the world is in a mess. So everyone kind of, is trying to figure out, like, where do I do this? How do I kind of like maneuver the world? So maybe for a start, could lay out like your macro views on some of these like big world events, and then we can roll from there.
When it comes to our outlook, when you think of what happened this past weekend, right? US and Iran managed to sign a deal, but even there were some hiccups there, right? So it really underscores the tension underlying where, yes, there is a deal. We do expect when it comes to house view for a peaceful conclusion to happen over the coming weeks and months. So there is our base case. But at the same time, you have the 60-day negotiation period, and then you can see more tit-for-tat volatility there. But when it comes to house view, we still do expect the Fed to remain on hold this year because we're expecting there to be a resolution. And once that happens, things will normalize, inflation gradually normalizes, and perhaps there's no more mess. But at the same time, when you look at what's happening out there outside of just a conflict, right, there's still underlying tariff policy, trade negotiations, and all these tensions. So there's still room for volatility if you look at many, many years ahead. So yes, right now, I think everyone's just zoomed in on this conflict, which is definitely a key source of risk. But there are also out there other risk factors that we're watching, such as AI disruption, or will this AI investment lead to actually a productivity gain, or will there be a bubble? So there's also another source of risk. But in general, when it comes to conflict, the bottom line is, as of now, we still do expect for there to be a resolution.
Okay, that's interesting. So just so I'm clear, you're expecting the Fed interest rates to be on hold
through the end of through this year.
Through the end of the year, and then you are expecting some sort of settlement between the US and Iran.
Eventually.
And eventually, what's the timeline that we're looking at?
So it will matter because as long as, if let's say conflict resumes and then the Straits of Hormuz gets blocked again, then you're getting more supply disruption and everything else. And they will have an impact when it comes to inflation, especially for regions like ours, like Asia, where we are very much oil importing, right? So the longer that this drags out before we actually see a good conclusion, then there will be some impact. And there's also impact when it comes to government policy responses. Because from what you're seeing is a lot of countries within the region and globally, they're now rethinking about energy security, right? Oh, do we have the right sources for our energy? Should we think about building local domestic infrastructure? Or should we think about expanding the sources of oil that we have?
Okay, fair. So how does that then translate into like fixed income, right? Because that's all the like the big world stuff, right? But then like how does that affect fixed income strategies or like credit strategies?
Yeah. So when it comes to fixed income, as long as inflation is still a concern, your yield curve, and we're talking about the US yield curve here, will remain somewhat elevated. And as long as the yield curve remains elevated, the yield that you get on your fixed income investments are not much higher. And that's why you've seen all of us, when it comes to the street, fixed income managers, we've been saying that there's this generational reset in yields that's been happening over the past few years. Let's say you look at 2021. The US 10-year then was probably 0.8%, right? So the yield that you can get from buying a US 10-year bond is 0.8%. Now it's at 4.5. When you look at 30-year, back then it was 2. Now it's 4.9, 4.8, something like that. So it's the floor that you're doing, right? And then when you do credit, when you do emerging markets, you just get more spread on top of that. So when it comes to fixed income investing, the beauty of it is your forward-looking returns has a pretty strong correlation to what yield you enter in. So let's say you look at a market like global investment grade. If you pull back data through 2000, for example, so 25, 26 years of data, when you look at forward 3-year returns and the yield to maturity that you bought that into, there's like an 85% correlation. I think the actual number is like 83.5, something like that. But it's very high. The fact that all-in yields are now higher actually bodes well for fixed income returns going forward.
Okay, great. So, I think you were talking about this generational reboot. And recently, I think the MSCI came out and tried to like profess an estimate that the equity market will probably grow like about 4 to 5% over the course of the next 10 years. So don't mark me on it, but one of the big indexes essentially came out to profess that, right? So are you telling me that there is a good chance that fixed income can compete, with equities in the next decade, because
Definitely.
it's always a write-off, right? Nowadays, when people think about it, it's like equities first. Fixed income is to dampen the risk and then we'll kind of manage it. But what you're telling me now is that, it might turn, just so I get your point of view.
I mean, if you're forecasting 4 to 5% annualized return on equities over the next 10 years, then definitely fixed income will be competitive. With the caveat that we don't go back to Fed rates at 0%, right? If you go back there, then your base goes down from 4.5 to 0, and everything else goes back to 2021, right? Where even trying to get 4% on a return is hard on fixed income. But that being said, even when you look at equities, right, it's only in the past few years where we've had 20, 25% annualized returns. But actually, if you look at 20-year annualized, it's right around 8, 10%. And within fixed income markets too, the markets is so huge and there's very different appetites depending on your horizon, your preference for risk and yield, right? There's something that's yielding 2, there's something that's yielding 12 and 15. And we have strategies that grows across the spectrum, right? So no matter what you're trying to solve for your portfolio, whether it be, as you said, dampening volatility, there is a fixed income solution for that. If you're looking to even increase your yield or your income, there's a fixed income solution about that. Even earlier, we were talking about retirement, right? And in retirement, people look for income that they get, that monthly income, and definitely a source of that is fixed income.
Okay, yeah. Just now you mentioned about the correlation, right? I think historically we were looking at a correlation between bonds, equities, all these. Right? I think recently, because of I think Ray Dalio talked about changing world order, all this stuff, right? And I could see like the bond yields are a bit different across different regions, and also like a dissonance like from the Fed hawkish or being dovish, because some of the countries around our region they already raised rates. So how should investor or viewers right perceive that to be in their decision-making process?
Yeah, so that really underscores the point of global diversification. Because as you mentioned, you have regions which are turning hawkish. You have regions which are maybe more dovish, right? It's like a multipolar world. There's a lot of fragmentation around, not just within US versus Asia, but even within Asia, right? You'll have countries which have been doing well, And you have countries like Indonesia, Philippines, which have been going on a rate hike cycle due to their domestic policy and whatnot. So what that underscores is, as investors, we cannot just have a home bias or a preference for one market. We really have to look at it from a global lens, looking at it from a relative value perspective. Where can we find the best return for any risk that we're taking? Because at the end of the day, these are our hard-earned money, and we want to make sure we're investing it right and we're investing it efficiently. And oftentimes, it really does require looking at markets which may be a bit more underappreciated or you haven't really thought of in the past.
Before we proceed further, I think it's good to also establish like a framework of thought, right? Because you were talking about like, there's like 2% all the way up to like 15%. And I think that essentially underpins all like, fixed income or credit strategies, right? Whether is it like, investment grade or high yield all the way to private, that's the whole gamut of like solutions out there, based on the strategy. So maybe,
And I just wanted to touch on this problem that we are seeing among investors today, and is that a lot of them, they tend to, maybe for convenience reason or whatever, just hold one global fixed income fund. But the question that they have to ask themselves is, are they having a truly diversified exposure? Because a lot of time when you look at what the fund or strategy invests in, more often than not, it is very heavily exposed to the US. And that is where we're actually seeing a lot of volatility right now. And if you look at the broader fixed income universe, there are actually many opportunities ranging from investment grade to high yield. In terms of geography, you have Asia, you have emerging market, or even above emerging market in terms of risk level. You have frontier market, and they're all offering very good investment opportunities. So investors just have to be willing and also be able to uncover some of these good solutions.
Okay, so since we are questioning the world order, right, and all sorts of investment ideas, and there's concentration risk and whatnot, right? Maybe can give me a bit of color, like what separates an investment grade and a high yield? Right? Is it just some rating agency at the back tell me something, right? So just so we be critical about it, right? How do you kind of like see the difference?
It's a bit of 101. And when people think of investment grade, naturally they'll be like, oh, this is high quality, this is not so risky. And when they hear high yield, then they'll equal to like, oh, this is risky, there's a high probability of default. But that said, I think one has to be very discerning. So a lot of time we actually see very high quality, high yield issuer. And within one of our flagship strategy, we actually favor the BBB and BB space. So that is BBB is investment grade, BB is high yield, but we see that as a crossover space where it's the sweet spot of fixed income, where it tends to get you a very high yield-like return, but investment grade risk. So if you are actually not looking at that space, you could miss out, as I said, high quality issuer. You could miss out issuer that are actually rising star, meaning to say that they're actually on the verge of being upgraded to investment grade. So there are still a lot of opportunity worth looking at within high yield, and it don't necessarily mean that they are junk bonds or very, very risky issuers.
If maybe I can add another layer of complexity here. When it comes to fixed income, yes, there is this credit spectrum, right? Investment grade, high yield. You have all the way from AAAs all the way to D, which means defaulted, right? But there's also another spectrum when it comes to interest rate risk, or duration is what we call them. Let's say like an investment grade bond, for example. Yes, you may be higher on the credit spectrum, but typically those issuers are issuing longer dated bonds, which means they may be higher in duration. So to the extent if you are forecasting for it to be a rate hike cycle, then you probably wouldn't want to have long duration, right? So in that case, investment grade, yes, it may be default proof, but you're getting exposed more on the duration side compared to high yield, which may be 3 to 4 years duration, while investment grade is like 5-6 years duration, right? So there's just another layer of complexity to take into account. And when it comes to default probability, this always triggers me. But every time people say high yield equals junk bonds, it's a 20, 30-year-old nomenclature, right? When you look at Moody's, the research agency, the ratings agency. So they publish on an annual basis, they publish a default study, right? And it goes back data through 1983, 1970, you can take your pick. But let's say you look at the probability of default on average, going back the past 25 years. For a BBB bond, that's at 0.8%. For a double B bond, it goes slightly up to around 1% or so. If you go down to single B, yes, you go up to 3% or so probability. And if you do triple Cs, then it's 7%, right? But if we are focusing, as Nat mentioned, when it comes to doing that triple B or double B spot, these are actually somewhat default remote. And we're able to use our bottom-up credit resources to actually uncover the universe and find ones where we think this has good yield and spread for the risk that we're taking. And at the end of the day, this is all we're doing, right? We just want to make sure we're getting compensated for the risk that we're taking.
Yeah, fair. So are there certain pockets of these emerging issuers or some of these like interesting issuers that you think we should know about?
Yeah. So I think the one area, and I was alluding to this earlier, when it comes to underappreciatedness, is emerging market corporates. So within emerging market corporates, there is this concept called a sovereign ceiling. It's a bit of implicit. So let's say a country is rated triple B. Every corporate within that country has to be within that ceiling. So if let's say you have a corporate which on paper actually should be rated, like if this was in the UK instead of in Guatemala, for example, this would have been rated A. But it has to be below triple B because the country is rated triple B. And you have a lot of this information gaps within emerging market corporates that we can take advantage of. So we will be buying emerging market corporates, which is forced due to sovereign ceiling to be lower rated, means they go to the high yield market. So they are giving you high yield spreads and high yield yields. But on paper, balance sheets level is like IG.
I find that part of because there's a ceiling to the country where the company is from, and that then inevitably price them under high yield to be very intriguing, right? And then of course then that's the whole bottom analysis of the financials of the company. How well are they doing? And then you can, as a fund manager, you then decide like, okay, is this a company that you want in your strategy, right? So broadly, that's how it works. Essentially, there's two paradigms when evaluating credit, right? One is creditworthiness, which is essentially what we've tried to establish just now. And then the other one was time frame, right? Which is where you kind of touch a little bit about, this whole like time, depending on how long the duration of the bond, you are subjected to essentially interest rates risk. So if we contextualize everything of what you've shared just now into your starting idea of the Fed is likely going to hold the rates in the short to medium term. So that aspect of the strategy is probably more muted in your evaluation. Is that a fair statement?
From a baseline level, the fact that rates should remain elevated for longer means your absolute returns, no matter which area of the fixed income market you're doing, at least has a higher base. And that means your probability of having positive returns over the next 3-5 years is higher than what it was if Feds were to go on a rate cut cycle.
Okay, fair. So then what about like the illiquid markets, like private credit, where you're kind of not subjected to as much of all these kind of market movement because it's like illiquid to begin with, it's private. So like how do I then evaluate, these markets? Because there's been names going around and bad narratives going around, like, like all these private credit the markets are going bust, right? So like what is the objective reality? What's going on?
So when it comes to private credit, would I say systematic is probably too much of an exaggeration, but would I say there are cracks within certain pockets? Definitely. I think when you look at certain sectors which may be more ripe for AI disruption, those could be at risk for some sort of stress. Because naturally, if you have a company that is more highly indebted, more levered, means they have less flexibility to do additional investments to keep up for AI. And if their business model gets disrupted, then that could be signs of struggle. And when you look at what's been happening to a lot of the private credit market is there's been a lot of distress exchanges. There's been a lot of payment in kind, a lot of financial engineering to try and sweep away all this distress. Like, don't look here, look at here.
Yeah.
But to say it's systematic is probably too much of an exaggeration.
Fair. I understand what you mean. But that is the business side of things, right? And then there's a very big other part of the market, which is the governments, right? Where they're issuing, public credits, or what people would call government debt, right? So other than the usual ones that everyone kind of knows about, I'm just curious, like, are there certain like this triple B, double B kind of space that you think it's interesting when it comes to like the government bonds?
But when it comes to government debt, I think there are certain countries within the global map that we do think could see some stress when it comes to fiscal side. I mean, you have US, which, what's the number now? I don't know, 29 trillion, something like that, but huge amount of debt in their balance sheet, right? So when it comes to fiscal side, there could be maybe not risk, but the flexibility that they have if, let's say, they get hit with a recession or a growth shock. Usually, if you as a government don't have a lot of debt, you can issue more, help your citizens and everything, do infrastructure, investment, yada, yada, and help boost the GDP. But if you're already indebted, you're near to the ceiling, you cannot issue more significantly, then that limits the flexibility that you have. And when it comes to, so now we want to think about how do we diversify away from this risk? US, DM, a lot of them are seeing a lot of fiscal ceiling, fiscal policy challenges. So where do you look at? You look at emerging markets, because a lot of emerging market countries have their own idiosyncratic risk. And a lot of the issues that we're seeing, even geopolitical issues, to be honest, is coming from the DM world. And EM, emerging markets, can actually be a hedge to all this DM risk.
So objectively, it may not be linked. Okay, fair. I get it.
Yeah. So in regards to DM and EM, I think a lot of our
Developed
investors,
markets versus emerging markets,
market,
right?
yeah.
Just so you are aware.
yeah. So basically, most of our viewers, they might not be aware like what are the risks, because they are basically EM and DM, they are in different growing phase of their GDP or their growth for the country. So how should the investor view this when they build up their own portfolio of fixed income?
Yeah. So, I mean, when it comes to emerging market debt, there's a few ways you can categorize it. At the top, you will have, when it comes to currency denomination, you have ones that are issuing hard currency debt, whether it be on USD, Euro bonds, etc. And then you have local currency. And within those two currency segments, you have different issuers. You have sovereigns, you have quasi-sovereigns, and then you have corporates. So when it comes to an emerging market debt strategy, typically people will think of, oh, is a lot of this local currency? Which is technically not. It is a big portion of their market, but it's a very large hard currency market as well. And within Aberdeen, when we think of emerging market debt, there's a few flagship strategies that we think of. One is emerging market hard currency sovereigns. So these are government debt only, USD denominated. There is emerging market corporates, which is also USD denominated, but issued by corporates. And then there will be a local currency, which is your local currency bond, and there could be sovereigns, quasi-sovereigns, etc. And then there's one that we call frontier markets. So this is another layer of when it comes to debt development in country phases, right? You start from underdeveloping economies, and then you go to frontier, which has some capital market access, but not as much as their emerging market older brothers, and you have developed markets. And when it comes to looking at the risk there, it's the same as looking at any other bond, to be honest. Looking at duration, looking at are you getting good enough spread or yield compensation, looking at their credit ratings, and just underlying when it comes to company fundamentals and whatnot. You'd be surprised when it comes to certain indexes, like South Korea would still be counted as emerging markets, to be honest.
Yeah, but I would just also add on that the truth is when you look at most investors' portfolio out there, they are very exposed to developed market. And when they say developed market, it's like equals to US, right? Yeah. So there is definitely the flexibility to allocate more to Asia, to emerging market, to actually provide diversification. And I think back to what Nathan mentioned earlier about frontier market, which is really truly underappreciated. You'd be surprised that when you look at frontier market, right, over the last 20 years, the correlation to US Treasury is almost zero. So you can imagine the kind of diversification that it can bring to a portfolio. That is what the asset class is giving, and very idiosyncratic risk.
Okay, so what does frontier even mean? So such a marketing term.
Well, you can think of
what is frontier?
Sub-Saharan Africa, so places like Egypt, Nigeria, Angola, some Latin market.
Even closer to home too, like Vietnam, Mongolia would be counted as frontier. It's like a World Bank label for certain markets. But generally, they are countries which they have capital market access, so they can issue bonds even on the offshore market, primary market in USD. They are still developing when it comes to their GDP, their policy and governance and whatnot. But you'd be surprised if, let's say, I show you a bar chart that just shows 3-year return, 22% annualized. You'd probably think it's equities, but it's actually a frontier strategy.
Yeah.
Interesting.
But it's I just wanted to share this conversation I had with the fund manager a few years back, right? So he was saying that, it's just when people hear frontier, they naturally has this negative connotation.
Of course.
So we're like saying, okay, how about we call it
Marketing.
next generation
Next
emerging
generation.
market.
Next generation.
Okay,
Then you
okay.
can, it'll probably be more well received. But it's just that, sometimes we want to correct that kind of perception that investors may have, which may, at the end of the day, doesn't serve them the best, right? They will be missing out on really, really good opportunities.
Hey, welcome to the Financial Coconut Podcast Network. I'm your host, Reggie, aka your Chief Financial Coconut. And if you're loving what we're creating here, like, share, subscribe, share with your loved ones, comment in the comment section below. And yeah, we'll see you for great content on Chills with TFC.
So let's talk about the investing side of things for Singapore investors. So most of the portfolio that I see is like Singapore dominated. If not, it will be US dominated. They don't even look at fixed income at all. So some of them, they even treat like their CPF as their bond components.
Yeah, I've heard that.
So how do we decipher this fixed income to something that they can slowly add, like example, like 5%, 10%, slowly incorporate into their because some of them, they are looking at equities returns, right? Which is like, I think Google got about 100% return in 1 year time. So when they were looking at that, and then how do you form the perspective that, why should we be looking at 10%, 5% fixed income kind of thing? Give them some perspective on that. And,
Not sexy, yeah.
Yeah, other than not sexy, but then I think in terms of risk management, I think we
fair.
should get it across to our viewers also. Yeah.
As you will see in all of our presentations, there's something that compliance will want us to say, which is past performance is not indicator of future results. So yes, you can look at all kinds of equity charts, 3-year, 5-year, 10-year, it all looks good. But it's about going forward, right? How you're seeing, are you expecting 100% again for the next 12 months? If yes, then okay, by all means, you should be doing 100% equities. When it comes to portfolio construction, right, we want to make sure you are thinking of risk sequencing, of diversification. Because at the end of the day, if there's a growth shock to equity, let's say, the AI capex investments, you're seeing trillions of dollars being put into investments, but actually productivity, let's say, falls down, right? It doesn't really lead to meaningful impact, and then you see this bubble burst. What happens to your equity portfolios? Now you have to think, okay, in this kind of scenarios, what should I have in my portfolio? What kind of ballast, what kind of control can I have? And there will be, more often than not, is where fixed income comes in. And the beauty of fixed income is also, again, for whatever solutions you're trying to achieve, there's different strategies for it. If let's say you just want to be something that's a bit more resilient, you don't want to take a lot of credit risks, you don't want to take a lot of duration risk, then you look for something that's short duration bonds. If let's say you're looking for a fixed income solution where, okay, I've had a great run in equities this year, I want to take some chips off the table, but at the same time, I still want to get 7, 8, 9% returns, then that's perhaps you can look at areas where you talked about emerging market debt, frontier bond funds, right? So it really depends on the framework that you're trying to implement in your portfolio construction. But
and really the objective as
and the
well,
objective,
right?
yes.
Okay. So what are some common objectives that, fellow Singaporean investors usually come to you for? And then what will you share with them?
Clearly, as you alluded to earlier, fixed income as that defensive component. So hence they will expose themselves to money market funds, short duration. But we will also recommend that if you are okay to take just a bit more risk, you can look into investment grade space, right? Asia is actually a very good place to be. So if you look at Asia investment grade, and compare it to all other investment grade markets around the world, over the last 10 years, Asia investment grade actually gets you the highest return with the lowest risk. And then, of course, no surprise, right? Singaporeans love income. And fixed income is also their go-to investment to generate income. And when they want income, that's where we will talk about credit solution, and we'll talk about allocating to emerging market. And interesting fact, if you look at frontier market and back to how it can generate equity-like return, over the last 10 years, it gets you returns close to emerging market equity, but less volatile.
Okay, but just so I get context on that, right? If going forward, if we believe that the world is getting crazier, can this, pardon my street language, right? But I think that's what people associate it as, are these frontier markets still going to be fundamentally intact? In terms of their strategies and, you're investing in a nation, right? So are those things based on your look and feel of it, is it going to be intact?
Yeah, so there's a few things you can think of when it comes to this kind of risk, right? So one is you just look at what sources of risk are out there. Again, some of the big ones are, if you look at the DM market, right, there's US fiscal dynamics, de-dollarization, there's DM, developed market policy uncertainty. And a lot of these risks aren't really exactly correlated to emerging markets. So they can be somewhat idiosyncratic. So if you're trying to diversify away from this risk, you actually get a more meaningful outcome if you do EM. And when it comes to emerging markets, some of these countries are commodity exporters. So they've actually only been benefiting from the fact that oil prices are high. And that's why when you look at something that emerging market actually within the public fixed income asset classes range, year to date has done the best. Our frontier strategy has done something like 7.5% year to date. And that's despite what you see in March. When it comes to fixed income, the other thing too is your yield is a buffer, is a cushion before you hit negative returns, right? So the higher that yield is, the more cushion you have. When it comes to forward looking, yes, there can be some challenges, there can be some risks. We're not going to be saying next 5 years, no downgrade, no defaults. Definitely not. You will see some of it. And that's where you need to partner up with someone who has a specialty, with someone who has a track record in being able to do this kind of things.
Maybe we contextualize on one of the other common things that I think Singaporean investors, they look out for, like back on your income kind of like strategies, right? When people are, especially when it comes to like retirement, I think last year there was the closure of the special account. Was it special account? Or was it retirement account? One of the accounts closed, right? And then there was like a whole kerfuffle out there, like, where do we put our money now, right? So I give you that context. If today I am the retiree, because I have talked to many retirees, as now I have a lump sum, and I'm a retiree, right? I don't want much risk, right? And I want income, right? So in that context, in the world of strategies that you dabble with and you construct, right? Like, what do you think is a strategy that makes sense for that context?
Yeah, I guess if you look at what are they replacing, which is kind of a CPF asset, which is something that meant to be conservatively managed, then I would say that a good option would be short duration fixed income strategy, because just by looking at the entire short duration credit universe and through good selection, you can actually get much better yield. We're talking about around 4 to 5% in US dollar terms, and yet managing your volatility very low. Yeah, so for instance, our strategy, we are targeting volatility that is about the 1 to 2% mark. That's what the kind of yield that we are seeing the asset class yielding at the moment. And they both fall under the high quality defensive bucket. So I would say it would be quite a nice replacement for that kind of CPF assets.
Maybe we can look at the other spectrum, like the retirees, and then now a young investor who wants to go into like building up their first portfolio, and they're very excited about it. And then
they're
they
not
want
excited
to,
about fixed income.
but they're not excited.
That's like fixed income as afterthought. Yeah.
So it's like a fixed income is only they suffer burns in their early years, then they start to incorporate fixed income into their portfolio. So how do you try to communicate this thought about fixed income to the younger investor to really build up from scratch? Fixed income should always be in your portfolio. How will you want to say to this group of investors?
Yeah, I would say that the numbers don't lie, right? So if they don't want to sacrifice the equity-like return, then yes, we are giving you a fixed income opportunity that has equity-like return, but at a lower risk. So it's like you're getting the best of both outcomes. So why not, right? So at the end of the day, it's about really showing them what the asset class has been able to deliver, and to highlight some of the positive attributes of these asset classes, right? Like the volatility angle, the diversification angle, and that should warm them up towards some of this fixed income.
Yeah, no, I think if the story is intact, right, that means like the central bank rates continue to stay elevated, right, and then the equity markets continue to kind of like move laterally, other than some of the big AI stuff, then naturally people will look for these type of solutions, right? So the market will turn because the palette turns and the industry will then turn, right?
Just now we talked about like the crazy market nowadays. So they are talking about higher for longer kind of rates. So how should investors look at risk in terms of risk? How should they look at risk And then what are the trade-offs they should be aware of?
Yeah, so when it comes to higher rates for longer, right, I think the key risk to really take into account is when it comes to are borrowers able to service their debt? Because the fact that rates are higher, that means your borrowing costs are higher. And if you have floating rate borrowers, then your cost for debt is also higher, right? So I think having that credit lens, right, looking at fundamentals, looking at, okay, is this issuer credit worthy? Do I expect them to keep on paying their coupon, repay their debt, right? So that's probably the key risk to look at. But also on top of it, to also look at what's next, right? Because rates aren't just going to stay higher for longer for the next 30 years. There will be some pivots, right? Whether it go up or whether it go down.
Okay, then you can come on the show again.
Okay.
Right? Then you share the cycles have changed. So I think that was a great discussion on the different pockets and the strategies out there, but I know you've kind of name dropped a lot of different strategies. So I just want to give you an opportunity to sum up, like, what is your favorite strategy thus far, right? That you think people need to be more aware of, so we have a takeaway.
I would say that my favorite strategy would be our global income bond strategy, which is a multi-sector credit. And I mentioned earlier in our discussion that it focuses on the sweet spot, right? That BBB, BB crossover credit space. So just from that kind of risk-adjusted return angle, I do favor that strategy.
Contrary to what the white hairs on my head shows you, I actually still have a pretty long investment horizon. My favorite will be the frontier bond strategy, because when you look at what's actually happened is over the past 10 years, it's given you pretty much equity-like returns, where it's around 9% annualized. But risk is definitely not equity-like.
Okay, fair. Thank you. Appreciate it. I hope you enjoyed today's episode. I think credit is underappreciated, right? Especially when the markets are turning, where interest rates are much higher, and the equity market looks a bit like where are we going, right? So I think there is a gap in trying to see whether this fits your portfolio and better understanding this whole big bunch of asset class, which is actually a bigger market than the equity market. Right? It's just oftentimes written off. So yeah, with that, if you love what we do, head over to thefinancialcoconut.com to put your email address. And so if our audience enjoyed today's episode and they would like to connect with you further to better understand your strategies, where's the best place to go?
Well, you can go to our website where you can find our contact details, and you can also find more information on our fund strategy and insights as well.
Okay, so yeah, meanwhile, take care. We'll see you next episode of Choose with TFC. Bye-bye.
Bye.